And this is our first plenary with the conservation financing stream supported by the Canadian Council on Ecological Areas. And I will be passing it over to Xavi again to introduce our speaker. Over to you, Xavi.
Thank you so much, Don, and welcome everyone. I hope you had a nourishing nature break. Our next plenary session is called An Overview of Conservation Financing in Canada and Beyond, which will be led by Paige Olmsted. Paige Olmsted is a senior research associate with the Smart Prosperity Institute, a national research network and policy think tank based at the University of Ottawa. With a common thread of connecting people and nature, her work has spanned rural agricultural settings in Latin America and Southeast Asia, advocating for change in international policy settings, and providing sustainability guidance to private sector actors. During her presentation, Paige will provide an overview of conservation finance globally, across Canada, and within the community of parks protected and conserved areas, in addition to sharing with us tools and how to meet the goals of biodiversity conservation. So let's give a warm welcome to Paige Olmsted. Paige, take it away.
Hi there. Thanks so much for having me. I'm really excited to be joining and for all the exciting activities that are going to be happening all week. As Xavi mentioned, my name is Paige Olmsted, and I'd like to acknowledge that I reside on the traditional land of the Anishinaabe, Huron-Wendat, and Mississaugas of the Credit, where I am joining you from today. I'm just going to bring up my slides that are going to accompany my presentation, and we'll get started. All right, hopefully, Xavi, I can see you. You're the only person I can see. So if you can give me a thumbs up that the slides are there, then I'll keep going.
Yep, you get a big thumbs up verbally too.
Great, thanks. So yes, as Xavi mentioned, I work with the Smart Prosperity Institute, and a new initiative of the Smart Prosperity Institute is something we're calling the Nature Investment Hub. And I'm going to be referring to that a bunch today because fundamentally what the Nature Investment Hub is about is conservation finance in Canada specifically, but to provide some context, I'll be talking about some other examples today. And it's about scaling public and private investment in nature, which is, I know, something that is a big priority for folks in this virtual room. And fortunately, for those of us that care about nature, we have seen more nature headlines than we've been used to in the last several years. This comes from a variety of different sources. Certainly big conservation targets, including the 25 by 25 and 30 by 30 that align with the UN targets. That's for conservation as well as restoration, which is something that Canada has signaled as a goal. Of course, in any of these initiatives, centering Indigenous leadership is absolutely critical and fundamental to having success in terms of halting and reversing trends associated with biodiversity loss. But we're also seeing folks talk about nature in certain other contexts, including agricultural contexts, commercial forestry, other types of working landscapes where we recognize that we can improve conditions for nature. And then also terms like nature-based solutions are getting a lot of headlines where we consider what are the variety of ways that we can conserve, manage, restore nature to deliver on climate objectives, think about disasters that we're facing, and how this actually can support in achieving those objectives. And of course, if you're in this room, it's not just about meeting certain goals and targets, but recognizing that healthy, functioning ecosystems are absolutely the foundation of resilient and prosperous communities. And so if we know and understand that, then the question can become, why is this so challenging to source funding? Why are these funding gaps for nature so consistent and so prevalent? And this graph is from a study that many of you may have seen or heard about, made a bunch of headlines a couple of years ago, which highlighted globally just how far we are falling short of reaching of the funding targets that would be necessary in order to achieve some of these global biodiversity goals. And another way of looking at this is considering, on the one hand, this sounds like a lot of money. $700 billion is a lot of money. And this was led by some folks at the Nature Conservancy in the US, but it was a global study making a lot of different sort of assumptions. But the point was the gap is a big one. And when we think about nature spending globally, we know, again, these numbers are a bit rough. You can, fudge them in a couple directions depending on what you're including or not including, but it gives you a sense of the orders of magnitude. We've got what we spend currently on nature and the needs, which we can see is an order of magnitude difference, and is a big gap, as the previous slide highlighted. But when we think about this relative to impact investment, which are folks that are really interested in seeing social and environmental outcomes with their investments, it is actually sort of a smaller slice. And then when we think about it relative to private capital markets, so stocks, bonds, equity investments, the kinds of things that make business headlines, it really is a tiny fraction. And so the question of conservation finance is, how can we access, or are there ways, or what types of financial instruments can help us access some of these types of dollars and money floating around for different purposes that actually can be put to very good use where we know there are tremendous needs? Part of the reason why getting from here to here is difficult is that nature investment is fundamentally different. And so I'm just going to provide some broader context here. And many of these issues will be quite familiar to you. For one, when you think about investors operating in traditional investment spaces, they're thinking about businesses, they're thinking about what they produce, they're thinking about the dollars and cents and revenue streams associated with them. And when we're thinking about what nature produces, while that value in many ways is immeasurable, when we talk about culture, or where we talk about recreation, or we talk about how we identify with nature spaces, fundamentally, those are harder to conceive of in the ways that traditional investors do. Even thinking about things like clean air and water, it's not the kind of thing that exists on stock markets. There's the issue of data. Of course, people that operate in nature spaces are collecting, often doing all kinds of monitoring and collecting data associated with biodiversity. But the way that that data is collected and what they're collecting often can be quite different than what investors who are evaluating a particular project over a particular time frame, looking for a particular outcome, are seeking. And so there is a sort of mismatch between what investors are thinking about and what folks on the ground are interested in measuring. Of course, ecosystems are not closed systems. If you're someone who's thinking about climate impacts and you can say, well, if I invested in a windmill, it's very clear over a certain amount of time, how much that windmill will cost, the kind of energy that it would save, and what that return on investment could look like. If you were seeking a similar climate impact in terms of restoring a forest, you can estimate the carbon impacts of that, but there's all kinds of other factors, whether that's forest fires, whether that's seasonal changes that can affect soil carbon, that are a lot less. It's more difficult to be confident, and those models aren't as solid. And that's not to say that that's a bad thing, but it's just not what traditional investors are familiar with and then see as riskier and can shy away from. As a result of that, often what this means is multiple partners are coming together to align these different value streams, and that collaboration takes time, costs money, and increase what we call transaction costs. And so, except for those that are really committed, this might not seem as appealing. And just highlighting, why it's hard to get from that big bubble to the little bubble. And so, speaking of investment spectrum in general, and this is intended to illustrate, going from minus 100. So if you have money to put towards nature and all of it's going there, and that's what we with grants, or what we traditionally think about, where public and philanthropic dollars are largely what's funding nature. And the question of conservation finance becomes, are there other opportunities? How can we structure certain types of investment strategies such that you can have, if we go all the way to the right, actual market level rates of return? So it does look like a traditional investment that someone in an investment space might be used to. And then there's actually quite a range of different opportunities that lie across the spectrum. Zero meaning you get your money back that you started with, but you're not generating a return. And then between zero and pure grant support means you're getting some kind of partial return. And the idea here is, if we have these different mechanisms, are there different organizations, groups, types of folks, and different funding that can be accessed when it looks different? And the other point to consider when you think about your own investment portfolios or your own charitable giving, for the things that you are simply donating to via grant support, often those are lower dollars than you can be talking about in these, across the spectrum. And that's part of the reason why the question is, again, how can we harness the significant amounts of capital that could be generating, benefits for nature. And when we think about who these new actors might be, and part of what I should have said at the beginning is part of why we're even considering this is closing that gap is something that there's a recognition that public sector dollars aren't going to be able to achieve on their own. And so, what are the ways that could be appropriate or interesting to engage with some of these other actors? And this is just a few folks that you could understand why might be starting to pay attention. For one, the insurance sector. You can understand that if they are making payouts when natural disasters happen, when there's damage to private property, they have very good data associated with the rising costs of climate change. And so you could understand how an insurance sector or a member of the insurance sector might be interested in restoration and conservation of watersheds if they know that doing so will actually reduce those costs when bad things happen. A variety of ways that the financial sector is getting involved. For one, just responsible investors, folks that are more conscious about where their money is going and the impact that it's having. Related to that, there are regulations that we're seeing in Europe and likely to happen in North America as well, where you actually can't just say an investment is green, but have to signify why and how and the impact that it's having, which will also likely require more action on the ground tracking what that means. Something else, financial disclosures. We see this in carbon, has changed the landscape quite a bit, where companies have to indicate how much impact they're having in terms of when you hear about scope 1, scope 2, scope 3 emissions and reporting that and accounting for that. If that emerges, or it is emerging for nature, and you can imagine if organizations are having to account for the impact they're having on nature, one, they're going to be measuring it more closely and understanding it, and ideally changing their operations to reduce that impact. But it also means that they'll be seeking out opportunities where they can recognize, either offset or do other types of activities to say, hey, we recognize we're having an impact here, and here's all the various ways that we're trying to do better. Accounting is also an interesting one because fundamentally what this is coming down to is, what are we accounting for when we make our decisions? I live in Southern Ontario. A local example of that can be where if you have this wonderful greenbelt space where there's recognition of food security and climate benefits and flood regulation that come from it, if you aren't accounting for that when you decide if a highway should go through that region, then it looks on paper like having a highway could be a good idea. And so where there are often questions about risks associating with valuing nature, it's a question of what actually counts when we're making decisions. And to have formalized accounting for nature can support more nature positive decisions in some cases. And the last point is just non-regulated businesses, meaning non-industry businesses that aren't required to offset their impact, but that for a variety of reasons, thinking about risks to the sustainability of their businesses in the long run, are thinking about, what does nature mean for our supply chains? What does nature mean for our license to operate? What does nature mean for us to be able to continue to be successful in the future? And so before going any further, I do want to point out something that I know comes up often when we talk about investment, private sector, financial sector, and the general discomfort of when we're talking about nature spaces, spaces we care about, spaces who make us who we are, and the idea that that could be corrupted or the integrity of what we're trying to achieve can happen if you're involving the private sector and private capital markets. So I just want to acknowledge I personally am very empathetic and sympathetic to that idea. And it's something that, you know, quantifying nature as can make me feel uncomfortable as well. And so a few points that I want to make and sort of situate this presentation in that context. So number one, aren't private capital markets what got us into this mess in the first place? Yes. When we think about environmental externalities, the way that people do business, short-termism, not recognizing the long-term costs of the way that many businesses operate globally and globalization in general, this is a big challenge. What I would argue is that nature has a value of zero in a lot of these decisions. And by thinking about the benefits that nature generates, it doesn't mean placing a dollar value on it, which gets to point three, but it does mean integrating the benefits of nature into decision making and raising the profile of what nature can do, and ideally ultimately changing people's values around what nature is and what it is for. Um, and so I've sort of jumped ahead, but are there risks of greenwashing? Yes. We don't have to operate with bad actors. It's a matter of also understanding where people are coming from, where your comfort levels are. So I'm not suggesting that this is always a good idea. I also want to add that conservation finance really just applies in certain circumstances, and that's what we're going to talk about in the rest of this presentation. There are lots of occasions where you simply need to support species at risk. There is not a business case for it. There's not a population nearby who can benefit from conserving that watershed. It's just something that's important to be done. And if there's not a conservation finance mechanism for it, that's fine. And so the intention with conservation finance is where there are opportunities to generate more dollars for nature, but certain and then that frees up some of that grant funding and other funding opportunities. So to increase the overall pie of money available to nature, not be converting how we raise money for nature. There's all kinds of literature and conversations, and I welcome questions about it if folks want to discuss it, but the risks associated with monetizing ecosystems. And as I said, the point of this is not to put a price tag on nature. It's really about, can we create positive opportunities where engaged organizations, all kinds of different organizations, can bring money to the table to do the things that we know need to be done on the ground. And so the intention is certainly not to perpetuate neocolonial systems, but actually invite, for dollars that are needed to do the work we want. Inviting dollars invites participation and the opportunity to shift perspective. So rather than seeing it as, a nature community corrupting its own values, seeing it as, can we have other funding sources engage, and as a result, their values may shift. And through that participation and engagement and recognizing the benefits of doing this type of work. And I guess a sort of related caveat in terms of my own personal experience. This is a photo of Killarney Provincial Park, where probably the best job I ever had, summer of 2005 will date me. As an undergraduate student, I spent the summer doing a 50 lake survey, collecting water samples, soil sediment cores, and spending time outside. I mean, it was awesome. And I just felt in an environment where lots of people are working in parks and protected areas, I wanted to say that, we are this, I think a risk that we have in the nature community is we tend to preach to the choir. And so I'm not coming to you as someone who works in the finance industry trying to promote the ways that operates. I'm coming to you as someone who is very much in your camp, but that tries to think about how can we bring the values that we share and what seems obvious to us outward. So I'm going to pivot back to some of these specific financial instruments and those that relate specifically to conservation spaces. This is the same spectrum that I mentioned before. So going from the grant funding minus 100, or not always grant funding, but where you do not see a return, or you do not see the return of your initial principal, as is the case of trust funds, but it is a sustainable financing mechanism, all the way to market rate returns. Now, the ones that are circled here I'm going to talk about in a little bit more detail, but also it's a relatively short presentation. So I've added the website for the Nature Investment Hub, where there's more resources, there's more details on some of these specific instruments, and then a resource page where there's all kinds of reports produced by lots of different organizations with a real focus on Canadian content, where you can learn a lot more. But I will mention a few to stimulate perhaps some dialogue, some thoughts, some interests that may proceed for the rest of the week. One thing I will mention briefly, that of these two at this end that have the most potential to generate revenue, which I won't be discussing further, are project or real asset management, which is ultimately results to selling land. And this is something that we see a lot in the US. So a lot of these real conservation finance success stories, equity funds as well. There's several in the US and Australia, and examples of real asset management there as well. are things that don't apply well to the Canadian context because they involve private lands, and 90% of Canada's land base is not private lands. And in the US, it's almost the opposite in terms of private versus public. And so part of the need for a hub and to have a venue to talk about this for Canada is that we do actually have quite a unique policy environment as well as land base and seascape to consider how and when these things can apply. One example that I'll start with that is outside of Canada, because it's one that once it happened, it got a lot of press and got a lot of people thinking about how things could be done differently. The California Climate Resilience Bond involves, and these box diagrams are quite common, that we'll see. I'm just seeing a couple questions pop up. I think those will get saved for the end. I think Dawn's going to moderate that. So I'll just proceed here for now and can address those at the end, but I will be leaving time for questions. Where we've got investors who have, actually, sorry, I'll start over here. In California, forest fires are obviously a big problem. The Forest Service in the US had billions of dollars of activities that had been delayed because budget was not available. Simple things for fire suppression, like even clearing roads so that when fires happen, folks can get where they need to go to reduce the impact of fire. And so when you think about who is harmed when fires happen, particularly in a really populated environment, you've got folks that are proximate, include communities, homeowners, infrastructure for energy, so hydro, but also the transmission wires. And of course, the insurance industry is also very much interested because when damage to those things happen, they're often the ones on the hook. So the way that this bond system worked is that investors put up money right away to do restoration activities. So all of this deferred maintenance was able to be addressed immediately instead of waiting years and years and years. And then these fires have increased costs associated with them. So money is put into this bond. Implementation partners do the restoration and benefits are seen. The beneficiaries, those that I mentioned, include these municipalities, insurance companies, utilities, pay money back, which gets back to the investors. And you think, well, how does this work? And that ultimately the beneficiaries are paying. And so what they are banking on is what they are paying is less than the cost of what a really bad fire would happen, or the cost associated with a really bad fire. So we could say investors put in $8 million to do the restoration. Over the course of 10 years, these beneficiaries are paying $1 million a year. So you can see that the investors are getting 10 million back at the end. So they have seen a return. The beneficiaries are banking on the fact that their million a year is going to be more cost effective for them to have a planned amount of money that is paid out. So easier to budget, easier to plan for, and that's more cost effective than a one-off $25 million fire. It's not to say that there won't be fires, but they're considering that these restoration activities will offset that cost enough that this system works. So that's something that it's not simple necessarily, but it was an interesting way to get dollars on the ground, activities to happen, and folks that anticipated benefits saw it as worth their while. A similar model that has applied in Canada, and this example, if you talk about conservation finance, is the one that comes up all the time, is the Deshcan ZB Conservation Impact Bond in southwestern Ontario. So a similar model. It's worth reading the details about this, and there's lots of materials that they have documented. I've got the link here to Carolinian Canada, that was the NGO that sort of facilitated this, but really deep partnerships with the local Indigenous community whose lands that this is taking place on, and considering how they're accounting for the impact is also done in a really in a two-eyed seeing approach that was quite novel and innovative. So in this case, similarly, there was upfront funding made available, habitat restoration activities with impact, and then outcome payers were those that said, if you meet these targets, then we will pay that amount back. What's interesting about this, and this relates to the next slide about payments for ecosystem services, is you could cut out the impact investor. You could say someone values an outcome, they pay that folks to do it. Where the impact investor comes in, that makes it's more complicated, but somewhat interesting. The impact investors in this case in southwestern Ontario, it's through a responsible investment financial institution and bond. And so it's often folks that have put $1,000 of their savings into this and they get, a 3 to 4% return and can drive by this landscape that they have said, I have helped contribute to this restoration. So while perhaps a more direct route could have been an outcome payer paying directly to those that do the work, by adding this extra layer, there is an opportunity for people in the region to feel connected, to get their money back. And they say, well, actually, now that I've got my money back, I'd like to put this towards another project now that I've seen, that benefits can take place. And so as I alluded to, folks may be familiar with payment for ecosystem services programs. Similar model, you have folks who are, sort of downstream who see benefits that are paying landowners or folks doing activities on the land to engage in some kind of activity that leads to benefit. So they can be simpler. You can have straight contracts where folks engage in this work, but without that sort of perpetual fund potential that can happen with the bond model. Carbon and biodiversity offsets, merit a whole talk, could be a week of talks. But what I think is interesting in the context of protected and conserved areas, it's just something that comes up a lot, and it's not always clear when they can apply. Additionality is really the name of the game here. And if that's not a concept you're familiar with, the main idea is that when you have a project, if you'd like to be able to generate revenue from a carbon or biodiversity offset or credit, you need to have a clear baseline and demonstrate that the activities that are happening would not happen in the absence of this, contribution or investment that's being made. And so the problem for conserved areas is if they are already conserved, then this is, it is not considered additional by the boundaries of a carbon offset. This is a major challenge that exists. If you think about Canada's north or just large and vast intact landscapes in general, they are vast and intact. There's tremendous ecological benefit and climate benefit of having things like that. And there's perverse incentives that exist from the offsets and the way that they've been designed, because it sort of signals it's only once something is at risk that you can actually generate an offset from it. So you can do it if you're acquiring new land to say this wouldn't have otherwise been conserved. Now I am conserving it, and there could be associated additional benefits that are quite clear. Certain restoration activities, if you're saying this is a degraded landscape, I'm restoring it, and through that restoration, I can make it very clear how that is additional. And then avoided conversion is this idea to say, well, and this is often forestry examples where you can say, well, we were allowed to deforest 80% and we're only going to deforest 60%. And so with that difference, we can generate offsets because we've avoided that conversion. But again, there are standards associated with this. It's quite costly. If folks have questions, we can get into some of those details. I think some of them may come up later in the week in some other presentations. I direct you to the Nature Investment Hub where there's more resources, but additionality really is the name of the game. And in Canada, there aren't a ton of examples of these projects because of the differences of different provincial regulations and where you have these intact landscapes that there's just not additionality. And that's not a failure, it's a failure of the system, a failure of a lack of imagination, a failure of tools. And so the question becomes, what would appropriate tools look like that can incentivize and reward stewardship of intact landscapes that we currently don't have, or that can incentivize and reward the benefits that are being generated by the fact that these protected and conserved areas or other types of nature reserves have been in place for so long and are continuing to generate benefits. So there's certainly room for innovation and creativity here when these types of activities don't apply. Carbon, again, lots of controversy and things we can discuss. The nature world is sort of emerging. So I'd sort of say, watch this space, or as part of the Nature Investment Hub, we're planning to have some webinars and activities related to what's happening with nature and what folks, what could be relevant to the Canadian context there. Trust and endowment funds. I had trusts at the front. Land trust, there's going to be a specific conversation about land trust later this week. So I'm speaking strictly on trust in terms of a fund that exists in a particular environment for the funding alone. And folks can be familiar with this. Universities and charities have use these, but ultimately where you have principal and you can generate some investment revenue from that, and you allocate pieces of that on an annual basis or whatever basis you choose to do. These have gotten a bit more publicity since the Tai-Dene National Park, or protected and conserved area, IPCA in the Northwest Territories, because they have used a trust model. And what's interesting and exciting about that is it provides operational funding on an annual basis, because often, as there's pressure to increase, to meet this 30 for 30 target, even though it's a large capital infusion to create that IPCA or protected area, sometimes it can actually be harder. There's the creation, and then there's how do you sustain that over time, and that's where a lot of the risk is seen. And Tai-Dene would not have happened had it not been for this financing mechanism that was community powered, where they hold the decision making of how that is allocated and dispersed, because of that risk associated with having to sustain something like that over time. So while it's promising, though, as a funding mechanism, the other question becomes, how can you raise enough capital such that what is being generated on an annual basis is sufficient? And so that's why this point about the largest scale possible. Actually operating a trust or an endowment is complicated. It's not something that's easily done for a small area or a one-off project. And so thinking about how you can work with a range of resources, a range of groups. There's certainly lots of questions to be considered, but scale is an important one, to be able to raise enough dollars to generate enough dollars, and where those sources of funding would come from, when they could also say, well, you know what, instead of giving $100,000 towards a fund, I'd rather see that $100,000 see impact right away. And so project finance for permanence, again, I know there's a session on this later this week, but it's something that's in the press a lot. It's something that's seen a lot of interest because of the federal government's commitment to see a range of landscapes be addressed this way. And I'm just going to mention that, what's exciting about it is it tends to be a blend of a range of these things that I just discussed. So there can be room for generating revenue for offsets, range opportunities to do straight conservation, opportunities to do sustainable management. And what's exciting is with a single closing date, you raise as many funds as possible, and there's less investor risk, because they know that it won't go ahead unless funding meets a certain target. And then once it has, then there's this series of a sort of a portfolio approach to having a different range of set of revenues. I am running out of time, so I will go quickly through these last couple slides. But what I just mentioned was this idea of a portfolio approach. And so for conservation, because revenue streams aren't clear, despite the range of benefits that are being generated, think about who is proximate to your region. Who are the folks that benefit? Are there ways that they could contribute more meaningfully and directly to the work that you do so that they can sustain those benefits? And thinking about who some of those partners and stakeholders may be. Data tends to be something that we need more of, and think about what are those data needs to demonstrate impact. And this last point is leverage. It's not just about accessing private dollars. Often what happens in the case of conservation is how can the available grant funding, philanthropic funding, government funding be multiplied? Use that as a way to leverage or reduce risk or attract other funders with those public dollars. I'll summarize briefly some of the things that make Canada unique or challenging. As I mentioned, public lands is a big factor. Are a range of governance structures, and some of which are complementary, some of which are not. Different regulations. A lot of the success stories, particularly in the US, have policy realities that aren't here. Vast intact landscapes I discussed, the challenge with additionality, and also just a lack of intermediaries. And those are when you have these arrangements, who is putting those together? Who is deciding, oh, actually there's a real opportunity here as long as we get these 6 partners in a room together. But as I mentioned, there's a lot of transaction costs associated with that. And so advancing conservation finance in Canada, we recognize there are policy challenges, data challenges, funding challenges, need for capacity support, guidance, and tools. And so this is where the Nature Investment Hub comes in. We hope that in supporting these actions that are needed, we can see more projects, and in doing so, this can reduce transaction costs, reduce risk, and increase investment, and see this sort of virtuous cycle take place. So I invite you to check out our website, where there's a lot more information on the things that I've discussed. And the last question I have is just, how can the hub help you? So if you have questions related to conservation finance, ultimately the intention of the hub is to serve the community. And so let us know what your interests are. You can let me know directly by contacting me. We can talk about it in the Q&A here, but ultimately the intention of the hub is to advance this conversation, advance knowledge and awareness, so that folks are able to engage in this space in ways that they feel comfortable, and that they feel like they have a sense of control and how this is moving forward. So thanks very much, and I invite any questions.